Hello, my name is Nick Quinn.
And I'm Shane Vernier.
And I'm Connor Woods. We are the market analyst team at howtotrade.com, and together we're going to explain everything you need to know about trading the descending triangle pattern. So let's get started.
A descending triangle pattern is a bearish continuation pattern. It's telling us that the trend is likely to continue moving to the downside. It's the exact opposite of an ascending triangle, which you'd find in a bullish market. Now, traders tend to use this type of a pattern as a way of refining their entries and their exits within the context of trading the trend. And its distinguishing factor is that lower support level. It's always horizontal, and eventually price compresses over time, and then we break to the downside. So let's have a quick look at exactly how we'd go about identifying it. A descending triangle is a very easy pattern to spot within the context of a downtrend. It's a continuation pattern, and what it's actually showing us is it's showing us that the market is failing to reverse. It's a failed attempt to move back higher. Now, what we'll be looking for, the key point to remember with this pattern is that we're looking for to draw a horizontal support line across the bottom. It has to be horizontal, and to confirm that, we need at least 2 attempts to move the market lower that have failed. And the same on the opposite side, the resistance that gets created as we create lower highs within the structure, that's basically a failed attempt to move higher. And we're looking it to be confirmed by at least 2 attempts to move higher. Now, once the market actually breaks lower to continue, the way we would trade this and get involved is we'd look for the candle structure to the downside that breaks out. From there, what you'd want to do is you'd use the close of that candle as a reason for initiating a short position. So you'd probably enter the close of that breakout candle, and then you need to then place a stop loss. Now, there's different ways that we could do that. One way would be to be very aggressive and place your stop loss on the opposite side of the horizontal support point that has now been broken. That would be very aggressive, but you've got to be very careful if you decide to do that, because it's highly likely that after an initial break, we're going to get some kind of a retest back up into that structure, so you could maybe get washed out if you're not careful. Another way of placing the stop would be to put it on the opposite side of the resistance of the diagonal resistance line. So that could be maybe here or even here. That would be another way of placing the stop loss. And the last way, which would probably be my favored method, would be to incorporate the actual structure itself. So find some sort of failed support point within the moves that have been created within the pattern, and use that as a place to place a stop loss on the opposite side of one of those areas. But nevertheless, that is the key way that we'd go about identifying a descending triangle.
So let's have a look at an example now. Now we're going to look at the descending triangle breakout trading strategy, because when you're trading market patterns, it's all about trading that breakout. And in this situation, it doesn't matter if it's a reversal pattern or a continuation. In the majority of cases, especially like this one, you're looking to enter a trade after that breakout occurs. Now with the descending triangle pattern, we can see the market generally trending to the downside at the moment, but you can see this reversal coming into play, and that's where this descending triangle starts to form. So if we draw this double bottom that we have here, and that's the key to drawing this descending triangle pattern, and then we've got this downward sloping trend line as well. As soon as we get that breakout above this descending trend line, you can see that the momentum starts to shift to the upside, and that's where we can get that real profit from trading that descending triangle pattern.
Okay, let's look at a few of the key pros and cons for the descending triangle pattern. Number one, the pattern is easy to identify and use. It is visually discernible. Number two, it offers us a clear breakout level, which gives us a specified market entry point. By using the measuring technique, traders can easily define the take profit targets and take profit levels. That means we have specific market exit points as well. Now, it's also one of the most reliable and accurate continuation patterns in all of technical analysis. Now, on the con side of the ledger, the pattern rarely appears in perfect formation, so there is a bit of interpretation and nuance involved in identifying the descending triangle in the live market. And lastly, it's not an effective pattern for swing and long-term investors. The descending triangle pattern functions best on intraday and daily timeframes. Now, let's review some of the key takeaways from the descending triangle pattern. Number one, the descending triangle is a bearish chart pattern that appears during a downward trend. Number two, traders use this pattern to find entry and exit levels during an ongoing downtrend. Number three, the key characteristics are a lower horizontal line, at least two lows, a descending upper trend line, at least two lower highs, and a price intersection. Number four, when using the descending triangle pattern, traders enter a short position when the breakout occurs. Now, if you want to learn more about the descending triangle pattern, be sure to check out the How to Trade Trading Academy inside our trading room. There, you'll find a longer form tutorial where we'll show you how to fit the descending triangle into your own trading methodology. We'll then demonstrate how to take that plan and trade it against real price action in the live market. You'll have everything you need to practice and gain experience. And once you're ready, feel free to join our How to Trade Funded Trader program.